When markets crash, most people see fear, chaos, and ruin. Traders panic. Families lose everything. But history hides a secret. Every major crash has created the greatest wealth transfer the world has ever seen. Those who understood the pattern didn't just survive, they became unimaginably rich. The next crash is coming, and it won't destroy wealth. It will transfer it. The question is, will you be ready? The illusion of stability. When people think about market crashes, they imagine fear and panic. They picture chaos on Wall Street, families losing their homes, and retirement dreams disappearing overnight. But the truth is rarely told. Every great crash in history has triggered a massive transfer of wealth. Those who understood the pattern didn't just survive, they prospered beyond imagination. Look back at 1929. Investors who bought in the depths of despair later saw returns that would make today's tech billionaires envious. The dot-com bubble of 2000 offered similar opportunities. Those who accumulated quality assets during the collapse multiplied their portfolios many times over in the following decades. Even the 2008 housing market implosion, which felt like the end of the world, became the starting point of the greatest bull market in American history. Now, the warning signs are flashing again. Every key metric suggests a massive reset is coming in 2026. And if history is any guide, this won't just be a correction, it will be the next transfer of wealth. The economic cycle and warning signs. The economic cycle in America has followed a predictable rhythm for over a century. Every 18 to 20 years, the system reaches a breaking point where debt, speculation, and artificial prosperity collide with reality. We saw it in 1929. We saw it during the stagflation crisis of the 1970s. We watched it unfold in 2000 and again in 2008. Now, as 2026 approaches, every indicator suggests the next inevitable reset is coming. The Shiller-Cape ratio, which measures how expensive stocks are relative to earnings, is sitting at its second highest level in recorded history. The only time it was higher was right before the dot-com crash that wiped out trillions in paper wealth. Consumer debt has reached levels unimaginable just a generation ago. Corporate balance sheets are loaded with cheap debt that will become crushing as interest rates rise. Government spending has grown so much that even the Federal Reserve questions whether the system can continue much longer. And yet the same economists who failed to predict past crashes are telling the public not to worry. They say the economy is strong, unemployment is low, and there's no reason to panic. The smart money moves. Meanwhile, the smart money is quietly positioning itself for what's coming. Warren Buffett's Berkshire Hathaway sits on over $300 billion in cash, the highest in the company's history. Major hedge funds are building defensive positions and accumulating precious metals. Institutional investors are quietly rotating out of overvalued growth stocks and into assets that hold value during economic chaos. The unemployment rate is expected to rise to nearly 5% by September 2026. Economists put the odds of a recession at almost 40%. Yet these same experts have never successfully predicted the timing or severity of any major downturn. Manufacturing has already begun to contract. Consumer confidence is starting to crack. Credit card defaults are rising. Commercial real estate is showing serious signs of stress. These aren't abstract numbers. They're early warning signals of the financial earthquake building beneath the surface. Crashes as wealth transfers. Here's what separates the wealthy from everyone else. While most people see crisis, the rich see opportunity. Crashes are not random acts of destruction. They are systematic transfers of assets from weak hands to strong hands, from those who borrowed too much to those who saved, from speculators to those who accumulated real value. The pattern repeats every time. Consider 2008, millions lost homes, jobs, and life savings. Yet a small group of investors bought real estate at 30 cents on the dollar, stocks of world-class companies at decades-low prices, and entire businesses for fractions of their intrinsic value. Amazon fell from over $100 to just $6 during the dot crash. Netflix traded for less than a monthly subscription. Apple, Google, and dozens of other companies were available at garage sale prices. Those who acted didn't just preserve wealth, they multiplied it beyond imagination. The predictable patterns of crashes. The same pattern has played out in every major crash in history. During the Great Depression, John D. Rockefeller reportedly said, "Fortunes are made when blood is running in the streets. While breadlines formed and banks failed, those with capital and vision acquired assets that would generate wealth for generations. Oil companies, railroads, and manufacturing businesses changed hands at prices that would never be seen again. Crashes don't happen randomly. They follow predictable patterns driven by human psychology and mathematical inevitability. Periods of easy money and speculation always end the same way. Debt levels that seem sustainable during good times become crushing when conditions change. Asset prices justified by new paradigms eventually return to historical norms with devastating speed. And that's exactly what is building now. Corporate debt has reached levels that make 2008 look conservative. Government deficits are spiraling. Consumer spending is supported by loans, assuming tomorrow will always be better than today. Asset prices have been inflated by over a decade of artificially low interest rates and money printing. The coming correction stock prices are divorced from underlying business fundamentals. Real estate values in many markets have reached levels that make ownership impossible for entire generations. Bond prices assume governments can always service their debts. But mathematics doesn't care about assumptions. Interest rates are rising because inflation refuses to disappear. Debt service costs are consuming larger portions of government budgets. Corporate earnings are under pressure from higher labor costs and slowing demand. Consumer spending is beginning to crack as credit limits are reached and monthly payments become unmanageable. The stage is set for a correction that will make 2008 look like a minor inconvenience. Yet when the crash comes, it won't destroy real value. It will reveal which assets are real and which were illusions. Quality companies will survive and eventually thrive. Prime real estate will retain its utility even if prices fall. Precious metals will maintain value when paper promises fail. Preparation and cash as opportunity. The difference between those who profit and those who suffer won't be luck or timing. It will be preparation.